Good morning, ladies and gentlemen. A very warm welcome to you on Business Today Television. Our special show, Market Masters, focuses on getting you to meet and understand the finest brains on Dalal Street, professionals who've made tons of money for their clients and customers over long periods of time. They've navigated volatility. They have navigated bull and bear markets with equal ease and have now attained a position where they command a lot of respect in the markets. Our special guest for today is Mr. Nilesh Shah, MD and CEO of Envision Capital. He's been in this position since November 2009. For the past decade and a half, he's advising and managing money in the PMS to the tune of 1,600 crores and is a veteran of Dalal Street. A very warm welcome, Nilesh ji. And we meet in troubling times given this crisis that we are seeing in and around our borders. How do you analyze the situation on Dalal Street at the moment? What looks good and what looks not so good?
So in the first place, I think congratulations to the government of India and congratulations to our armed forces and defense forces for giving a very, very befitting reply to this act of terrorism which has been indulged in. And I hope it's a message and a signal which is very, very loud and clear. What I'm appreciative about the fact is that the market has taken this in its stride. There was a bit of initial knee-jerk reaction when the act happened a couple of weeks ago. But over a period of the last 2 weeks, and especially after yesterday's of India's reply, the market has essentially shown a lot of stability. And so to that extent, I think the market has taken this perfectly in stride and focused more on the macro fundamentals of India, which are getting stronger with the passage of time. And that's what essentially the market is really focused on, and rightly so, that it should be more focused on fundamentals.
Okay. With this background and the fact that we seem to have sort of overcome this hurdle, as also the fact that foreigners seem to be keen to buy back into the Indian equity space, how is the advisory and the PMS structured at this point of time, Nilesh ji? What are you focusing on and what were on your buy lists over the last 20-25 sessions?
So firstly, just segregating between, the sources of liquidity, and there are DIIs, which largely get represented through mutual funds, insurance companies, and PMSs like ours. They have been kind of continuous buyers over the last maybe 4 to 5 years, especially in the post-COVID period. So that's always been very heartening, and domestic investors have not been discouraged or deterred by any of the noises which have been kind of echoing or surrounding us. In terms of the FPIs or the foreign investors, I think they have been a bit on and off. More so, they have been essentially been staying away or net selling. But in the last 1 or 2 months, they have now again turned constructive and positive on India. And I think the interaction that we have with various institutional investors clearly indicates that if last year they were cautious because of our valuations, this year they have turned more neutral and more positive, given the corrections that we have seen at the start of the year and some of the global developments which clearly point to a relative strength of India. Now, what are some of these global developments? Firstly is the expected slowdown or a recession in the United States, number one. Number two is the kind of outperformance which US markets has had. That's clearly not sustainable. Third, essentially de-dollarization or the weakness of the dollar and therefore strength of various emerging market currencies. And therefore, there's clearly a trade shifting away from US equities into emerging market equities. And within emerging equity markets, India stands out. Foreign investors have been underweight on India versus its weight in the benchmark or in the MSCI benchmark. So I think in that context, it probably are looking now for an opportunity to kind of to catch up on their India allocation. So India's growth of 6% plus, the fall in crude oil prices, inflation trending lower, and the path of fiscal consolidation are creating very, very strong macro tailwinds which is making India stand out as an investment destination and is attracting foreign investors to recommence their investments into a growth market like India.
Okay, and to this we can also add the fact that the GST numbers for the month of April crossed 2 lakh crores for the first time. So the underlying economy seems to be getting back on track. With this background in mind, Nilesh ji, and the fact that probably monsoons will also be good this time, how are you structuring your portfolio? What are you advising clients in terms of choice between large caps, mid caps and small caps? We understand that you run a multi-cap portfolio which is bottom up.
I mean, just kind of touching upon those macros a bit, apart from record GST collections, where GST collections grew at 12.6% for the month of April on a year-on-year basis, I think a couple of extra data points which are very, very important, which suggest a revival of manufacturing activity. First of all, the manufacturing data for the month of April is coming at a 10-month high. And secondly, is the demand for jobs under Manrega has essentially kind of declined for the first time after 6 months. So this clearly shows that manufacturing activity is back in India despite the global headwinds that we keep hearing of around trade and tariffs. In terms of essentially our thought process in terms of investment opportunities, what we believe is that with India growing at 6%, nominal GDP growth of around 10%, the large caps are, probably will grow their earnings at maybe between 12 to 15%. And therefore, there are a few large caps which kind of are very attractive. But we see a whole bunch of mid-sized to emerging kind of sized companies or emerging businesses which have the potential to grow north of 15%, maybe more like 20% over the next 3 to 5 years. And that is really where we are focused on, because we believe that equity markets and investment outcomes are more a function of growth and capital efficiency, governance, and the price you pay for these businesses. I think it's a combination of these four ingredients which drive investment outcome. And we clearly believe that with the kind of economic reforms that have happened in India over the last 5 to 10 years, mid to small sized companies have now got a level playing field versus the large companies. So across sectors, we are kind of liking more the mid to small cap kind of companies.
Okay, Nilesh ji, your approach would be to focus on growth opportunities, or are you looking at maybe a sectoral push as well? I again repeat my question, is it a bottom up approach to stock picking where you look at these four parameters of capital efficiency, governance, growth and of course EPS expansion? Are you looking at bottom up or sector specific?
So we are more focused on bottom up. We clearly believe that it is individual companies which essentially create wealth and generate returns for investors. So we remain extremely bottom up. But within that bottom up, we are liking some themes, we're liking some sectors. The two most powerful themes that we are extremely optimistic about are around urbanization and second is digitization. These are the two opportunities that we clearly believe are structural opportunities from an India standpoint. The urbanization opportunity is more driven around India's growing middle class, the whole shift from farms to factories, from villages and towns to cities, which is creating a huge amount of demand for various consumer goods, various services, and for financialization of the economy. On the other hand, digitization essentially is helping government, it's helping businesses, it's helping consumers to adopt technology and create a new way of buying products, consuming services for their savings allocation, for their investment allocation. So we clearly see these two as the most powerful themes. In addition to that, the third area which is becoming increasingly interesting is this whole opportunity around manufacturing driven by indigenization and export promotion. So we clearly believe that these are the three very, very big investment opportunities or investment themes where we are basically looking out for bottom up investment ideas.
Okay, so three broad themes to look at. Some of them are also, propped up by this rising consumption in India. Uh, Nileshji, how many stocks would there be in the advisory as well as the PMS? Overall, you advise and manage about 1600 crores.
Yes, so we own about between 30 to 40 companies on portfolios which are fully invested, but it's a range of 30 to 40 companies. But I would probably say that, maybe the top 15, 20 positions would pretty much comprise bulk of the portfolio.
Okay, so this is how it is structured. And how many of them would be large caps and how many mids and smalls?
Broadly, I think yeah, about 20% of the portfolios would be large cap, and the rest 80% would be between mid and small cap.
Okay, would the top three positions be in mids or large?
It would be a combination of, I think, largely the top two positions, the top three positions would be large caps.
Okay, fair point. And by any chance, would they be in the banking sector?
Yes, one of the banks is amongst our top positions. Yes.
Okay. Now, let's get into this banking space. Nileshji, you've been a very, very long observer of the markets, and some of these banks were underperformers in the last 5 or 4 years for various reasons, whether they were mergers or whether they were just overvalued. But what catches your attention at this point of time in the banking space? How do you view the next 6 to 10 months or maybe 2 or 3 quarters, given the fact that liquidity is back into the system thanks to the RBI? We have 2 rate cuts, and perhaps, just perhaps, the credit cycle is expanding.
Yeah, so that's a very, very pertinent question. And if I were to kind of look at the big banks, almost about 5 years ago, they were clearly very highly owned by foreign investors. And clearly, in periods when foreigners have been net sellers, clearly the big banks face the brunt of this selling. So that's basically the first from a pure liquidity point of view. So I would probably say there was kind of an oversupply of these securities versus essentially a demand for them. So that's the starting point. In terms of the business, over the last maybe 2 or 3 years, we've had situations which are more about tighter liquidity and some kind of restrictions which had basically come in from the regulator to ensure that growth in credit is more orderly and that it does not, the asset quality situation does not slip away significantly. Uh, what has happened now is that, and then of course, one of the big banks essentially has also underwent a merger
Hmm.
with its parent entity. And so that also created some challenges around the consolidation. What has happened is that now that consolidation of the merger is behind them, number one. Number two, the liquidity situation has improved quite significantly, thanks so much to the steps taken by the Reserve Bank of India. Third is with inflation trending lower, interest rates are also trending lower, and that is essentially going to reduce the cost for a lot of these banks. And therefore, that will help them to basically sustain or maybe marginally even improve their lending spreads. So overall, what it looks like is that going forward, given the kind of nominal GDP growth rate that we are likely to witness, improved liquidity conditions, and maybe an improved outlook on cost of funds or cost of borrowings, we clearly believe that banks today are very, very favorably positioned. In addition to that, if foreign investors continue to come in and step in and buy in a very, very significant way, it's relatively easy for them to put to work millions of dollars or hundreds of millions of dollars basically
Hmm.
into banking space or financial services because they're
Hmm.
relatively more liquid. So I think on the whole, we see basically improved liquidity as well as improved fundamental prospects for the banking sector going forward. And that what makes us positive on both banks and lenders.
Okay, I think that's a wonderful explanation, and the fact that foreigners were amongst the top sellers in nearly all private sector banks in the last 24, 25 months, and if they resume buying, then this is one sector that they'd like to top up. Incidentally, April was also the month in which DIIs for the first time in 22 years became larger holders of corporate India versus FIIs. So that's also a good sign of Atmanirbharta. Nileshji, how are you viewing the entire PSU basket? We've had massive wealth creation between, say, 2020 and 2024, then a nice correction in many of these companies, and now maybe there is a leg up that's coming. Is your portfolio of 30-40 companies reflective of the PSU story? If yes, what are the themes?
Clearly, yes, agree that PSUs have had a very, very significant turnaround. And we earlier on in the last 5 years, we've had some exposure to some PSUs which have mainly been in the defense space. That's really where we have been focused on, because we clearly believe that defense is one space which pretty much is relatively immune to what's happening world over, or even from a domestic economy point of view. There's a huge drive towards indigenization. And obviously, the current geopolitical environment warrants a higher spend on defense. So clearly, if in the PSU pack, if there is one area which we really like is the defense space. In the past, we've had some positions in the defense space, but we basically exited a few of them. We exited them some time ago. And we are now essentially kind of continuing to reevaluate them and see which amongst them is basically the best opportunity. Outside of the defense space, while there are multiple opportunities, but we prefer to be in the PSU segment where we think they have a very, very strong kind of monopoly, I would probably say. In areas like banking and all of that, they face stiff competition from the private players, but in areas like defense, they pretty much have a right to win. And that's why within the PSU pack, we like the defense space more versus any of the other kind of sectors.
Well put investment thesis, and of course, defense has been doing amazingly well over the last 5 or 7 trading sessions. Nileshji, what about sectors that are impacted with tariffs? How are you looking at IT? How are you looking at pharma? How are you looking at the export basket? This in itself was a very significant percentage of the broader markets. They seem to be pulling down the India story. How are you playing these in the 30-40 stocks that you have in your advisory and portfolio?
So we do have some exposure to manufacturing companies which have some part of their revenues coming in from exports, and within exports, a fair share coming in from the United States. We also outside of and within manufacturing, we basically have exposure to pharma companies or life sciences companies which are exporting. We also have some exposure to IT services companies where they have been providing IT services to the Fortune 500 companies. On that, and on both these sectors, there's really so far no announcement in terms of tariffs so far, in terms of both pharma and IT services companies. And we believe that the demand for both pharma and IT services is pretty much kind of non-discretionary, which means I don't think companies in the US can do without Indian IT services companies. And I think the consumers in the US probably cannot do without medicines manufactured in India, especially on the generic side. So we are not too worried about really whether business will be over for them or not. But having said that, tariffs has created some element of uncertainty, which implies that maybe for the short term, which is maybe for the next few quarters, there could be essentially challenges in terms of growth for these companies. It's not that they will degrow, but just that the growth levels might come off from maybe a double digit to a single digit. So one has to be really careful right now and see how the situation emerges. Number one. Number two, in addition to tariffs, there's expected slowdown or maybe a recession in the US economy. And if that were to happen, businesses which are dependent on the United States for their business essentially can also face a slowdown. And I don't think in that environment, be it IT, be it pharma, or be it textiles, or be it gems and jewelry, all of these sectors will face challenges in terms of a slowdown in demand, But I believe that that is something which could probably last for maybe the next 2 or 3 or 4 quarters, or maybe the rest of this calendar year. And then I think it will kind of be back as business as usual. In addition to all of that, since you talked about tariffs and exports, we have to also keep in mind that India has just signed a trade treaty with the United Kingdom, or it has been finalized. By the end of the year, we will have one finalized with the European Union. We've finalized one with Australia, maybe, a year and a half ago, and we would probably in the next few months sign with the United States. Now, these were things which were missing earlier. We will now have these bilateral and free trade agreements. What does this mean on the whole? It means that we will participate more in global trade. Our exports businesses will get encouraged, and this will give up an additional leg up for India's GDP and Indian businesses to grow. So while in the short term there can be headwinds, but over the medium to long term, I believe all export facing businesses are very, very favorably positioned.
Okay. Uh, Let me just bring in the valuation picture at this point of time. Nifty, as we see it at the moment, is now within one standard deviation of its long-term average as far as EPS is concerned. We've had a record high, Nilesh on Bank Nifty and Fin Nifty over the last 15-20 trading sessions. In your estimate, given the positives that you mentioned, whether it's the macro balance sheet or the two trade agreements which are in the pipeline, one already with us, plus oil at 4-year lows. How do you see the broader structure of the valuation table that you deal with, and where do you think would Nifty be 1 year from now?
So clearly believe that the worst is behind for Indian markets. The kind of lows that we saw in February or March or at the early part of 2025 pretty much should be about it, unless the world witnesses a black swan event. But I think and you can't be essentially factoring in those kind of situations because those things are more hypothetical. But I think barring any of these hypothetical situations, we clearly believe that the best times for India markets lie ahead. And we believe that the overall, based on GDP growth, nominal GDP growth, we expect corporate earnings to grow at 10 to 15% over the next 1 year. And so we would expect the markets to be higher at least by around 10 to 15% over the next 1 year or so. Hard to put kind of a level or anything like that, but I clearly believe the kind of correction that we've already witnessed and the strength coming in from good macros for India, we would expect essentially both earnings and markets to be 10 to 15% higher in over the next maybe 12 months or so.
Okay. Nilesh, no interview and no talk this time is complete without discussing gold. This is something where a lot of speculative money, I believe, which could have come into equities, has headed towards the precious metal. People have minted millions, and this 1 lakh rupee per tola is becoming a lightning rod for people to get into the gold market. How are you analyzing this part of the equation? Is enough, or will we see better days for gold from now on?
Um, I belong to the Warren Buffett school of thought in terms of gold, which is essentially saying it is a piece which basically creates no value or offer no value. So purely from a fundamental basis, there is really no way to basically figure out what is the real worth of gold. But having said that, it's obviously had a very dramatic kind of an up move, which is partly to do with the weakness in the dollar. And there are basically expectations that gold will probably become the next best store of value, or like what some people describe that as a reserve currency. But clearly, I believe all this is more speculative. You are right that everybody wants to currently own gold and buy more gold. And these are clearly not the best of symptoms, or these are the symptoms when any asset class tends to basically start to peak out. So my view is that yes, can it go higher? It can go higher. But basically, those who want to essentially buy gold on an incremental basis may probably should wait for some kind of a correction if they wish to basically own it. But I still believe that over the medium to long term, equities have the potential to outperform gold as an asset class.
And Nileshji, since you brought in Mr. Buffett into the conversation, an era seems to have ended with him hanging his boots at a ripe young age of 94. One has wishing that you break his record, both in terms of the returns he's brought up and the consistency over many, many decades that he's brought in. But what are the three major lessons that you learned from him apart from gold?
I think, first of all, thinking long term. That's number one. Number two, the power of people. I think the human mind is irreplaceable. I mean, you cannot essentially replace the human mind, and therefore the faith in terms of the management quality. And third is clearly margin of safety. It's very, very important to have a margin of safety. So I think it's a combination of these three things. Thinking long term, the power of the human mind, and margin of safety are the three biggest lessons or mantras that I have learned from him or picked from him. And and Shalendraji, I think while he is in his 90s, and obviously physically one may say that the era is coming to an end, but I clearly believe that his thoughts will remain immortal. His thoughts will remain forever.
Kya baat hai. With that wonderful thoughts, Nileshji, we'll call it a day. As always, 25-30 minutes is very little time with you, but from whatever we could gather from your wisdom, there's enough and more to think and chew on as far as Indian equities are concerned. Thank you so much for your time, and as always, the very best to you and to your clients.
Thank you so much, and look forward to interacting with you soon. Best wishes to you and all your viewers.
Thank you so much. That, ladies and gentlemen, was Mr. Nilesh Shah, MD and CEO of PMS and advisory firm Envision Capital. I'll just broadly recap what he's told us. The broader macro structure of the Indian equity markets looks pretty good. GDP growth is above 6%, inflation is trending down, so are interest rates, oil is down, as also the fact that manufacturing sector seems to be showing signs of pickup. All put together should translate into 10 to 15% earnings growth, and that's how the upward trajectory of markets should happen. The broader themes that Envision Capital seems to be investing in are urbanization, digitization and manufacturing, plus the export incentives that the country is offering. Apart from that, defense PSUs look to be a sub-segment of the PSU basket that seems to be doing well, given the problems that we face with our two neighbors and so the geopolitical setup, and of course the fact that gold might hold its allure, but it looks overdone and overcooked. Thank you so much for watching this wonderful interview. Please continue to be with Business Today Television. There's a lot that's happening on the other side of this break.